Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for the segment, we have Ryan McCormack, factor and core equity strategist at Invesco, to discuss weekly performance in the Nasdaq-100. We'll also take a look at some revenue streams from the largest Nasdaq-100 companies. Ryan, it's great to see you as always. Welcome back to Trade Talks. And it seems as if the market is in somewhat of a holding pattern until we get that key CPI data tomorrow.
Yeah, I don't think we had a lot of help this week with economic news. Ultimately, over the past 5 days, QQQ and QQQM, they underperformed for the week, down 2.83%. That's against the S&P 500 down 1.67 and S&P 500 value down 1.18%. Last week, following Fitch's rating downgrade of the United States last Tuesday, we kind of saw risk off, equity sell off into the weekend. And then on Monday, we saw Moody's cut credit ratings of 10 banks, mostly small to mid-size, but put 6 large banks on review for possible downgrades, and noting challenges to profitability and funding might impact credit strength across the entire banking sector. So we had a little bit of a risk off kind of sentiment around that, and then you look at Friday. It's a mixed employment reports where the July change in non-farm payrolls missed expectations, and the June figure was revised pretty significantly lower. Report looked very different from the ADP report that we got earlier in the week on Wednesday that was sizably higher than expectations. So I think it kind of shows the challenge of interpreting of what's really going on in the labor market. On top of that, we saw the unemployment rate tick lower to 3.5% from 3.6%. And then average hourly earnings, both on a month-over-month and year-over-year basis, rose higher than forecast, which of course brings some worry about increased inflationary pressure from wages. And Jill, I think to your point, it all leads into tomorrow's CPI report for July.
You know what, Ryan, it's so interesting. We had one of the world's largest asset managers on the show earlier, and they had said, based on investment flows that they've seen, that there was a dramatic shift to investors from being defensively positioned to more risky in July. And it seems that August has kind of been in a range and more ho-hum than anything else, if you will. So it's just something to think about. But as we take a look at the sectors that have been leading or detracting from performance, what can we see there?
Yeah, so for the week with the underperformance, tech was the biggest detractor. The sector was down over 5.3% in QQQ. And then underweight exposure to healthcare and also underperformance in the sector, that weighed on relative performance against SPY, the S&P 500 proxy. Healthcare was one of only 3 sectors in positive territory for the week and for both QQQ and SPY. But on the flip side, consumer discretionary was the biggest contributor to absolute and relative performance in QQQ, with overweight exposure to Amazon.com and Booking Holdings, along with differentiated exposure and Mercado Libre, propelling the sector higher.
And we've been taking a look at revenue streams for the Nasdaq-100 earnings for the second quarter earnings season. What have you noticed with Apple and Amazon?
Yeah, sort of a bit of a tale of 2 companies with shades of gray, but they both reported last week on August 3rd. And first off, Apple announced Q3 earnings that beat analysts' EPS and revenue forecast. However, it's the 3rd consecutive negative year-over-year revenue growth quarter for the company. And you can kind of see it in this chart. Apple revenue growth has certainly rebounded from the trough that we saw at year end, but it's still in negative territory. Whereas when you're looking at Amazon's revenue growth, it certainly fell from its tremendous 2021 levels, but has kind of bounced around on either side of 10% year-over-year revenue growth since pretty much last June. So, you look at Apple and CEO Tim Cook, he was encouraged by revenue from services, which would be, Apple TV Plus and Apple Music hitting a record of $21.2 billion. But from the analyst community, there's some concern around weaker than expected iPhone sales. Apple is expected to announce iPhone 15 at some point in September. And then, also on the earnings call, the company expects year-over-year revenue for this coming quarter, the one ending in September, to be somewhat similar to the June quarter, which, extrapolate that out, it's probably slightly negative year-over-year revenue growth. Shares immediately were lower by 4.8% after the announcement and down over 8% for the week. Now you look at Amazon that same day, they beat EPS and revenue estimates pretty handily. I mean, profits were boosted by CEO Andy Jassy's cost cutting measures that has been widely publicized for the year. But I mean, profits were significantly higher than expectations. And even you look at like something like AWS, their revenue sort of showed slowing growth, but it did come in better than analysts' expectations. And then on top of that, they showed guidance for Q3 revenue of 138 to 143 billion dollars. That was significantly higher than expectations for 138.3, and the stock jumped higher by almost 8.3% in the session following the announcement. So, I think ultimately the street is looking for revenue growth, not revenue improvement. They want revenue growth on a year-over-year basis. And, if you can combine that with strong metrics across underlying businesses and, of course, profitability like Amazon did, stocks are going to be rewarded.
Ryan, it's so interesting because look at the numbers that we're talking about, nearly 135 billion just in the second quarter for Amazon, nearly 82 billion for the second quarter for Apple. I mean, this is significantly more than most companies' market caps by a wide margin. It's just so hard to wrap your head around. This is how much money that they're taking in quarter over quarter.
And I mean, even when you start to break out the different business lines, right? I mean, that would make a company's year. But I mean, it's been the hallmark of these companies' success. I mean, it's splitting out these business lines that I think is sort of a testament to how well they've been able to diversify their business lines and tap into differentiated return streams to be able to post quarters like this.
All right, Ryan, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.